It is oftentimes as investors, I see people make this exact same mistake over and over again. Typing in meta stock here into M1 Finance, and you look that year to date, this company is down 59%. In the last year, it's down about 60% or so, and it's very easy to look at this chart and say, okay, this has been a growing company. The stock was about $400 a share, and today it trades at $130. I'm going to buy it now that it's down 2/3 in share price and hopefully eke out some big gains. Well, the problem is that today they reported their earnings and the company drops almost 20% as a result of the numbers that just came out. And so it's pretty funny because I felt like I had deja vu because I own Google stock and Google got crushed today. And when I said crushed, I was thinking 10% down, 9.63 to be exact, being down on the day was pretty bad. But it turns out I was pretty much spared because if you look at meta investors, they're down almost 20% just in the after hours alone, 19.22 as of the time of me filming, and it doesn't seem to have found a bottom anytime since they reported those earnings just a couple hours ago. Now you might be wondering, what did the numbers look like? I want to go over some of the brief bullet points, some of the main things that I think, and I think that the big thing that is concerning for this company is not the lack of revenue growth. They just reported their numbers and the revenue was not very pretty. In fact, it went down 4.47%, but the negative part of this earnings report is not the revenue. Now, don't get me wrong, negative revenue growth is not good, but that's not the issue. And we're going to go over in this video what exactly that issue is. So if you want to see this, if you're interested in meta stock, if it's a company that you own, and you want to see all the major bullet points behind this, then I would invite you to subscribe and check out all the stuff down below in the description, including M1 Finance, where you can get signed up and get $10 for signing up and help support the channel. So thank you guys so much for tuning in. And if you haven't seen me before, my name is Jordan. I'm a millennial investor. Here's my portfolio balance as of the time of me filming, my portfolio performance since joining this brokerage, and as well as here's my monthly balance, my portfolio holdings, my performance, my monthly YouTube income, and my lifetime YouTube income. So if you want to go ahead and pause on any one of those, you can go ahead and go back and view that. But let's go ahead and get started with the daily active users, and we're going to look at the couple major bullet points and numbers behind this earnings report, and let's go ahead and get started with the DAUs, or the daily active users. Now this actually came in quite decent. Last year they produced 1.93 billion daily active users, and this year it grew to 1.984. So a couple percentage growth there, not bad at all. Okay, so we're off to a pretty good start. Next, we look at the ARPP, which is the average revenue per person. And you can see that year over year, it went down from 718 to 753. Now that's not good, it's going down a little bit, but it's not anything that's wildly concerning. That's down, what is that? Just roughly in my head, I believe that's around a 7 or 8% downturn. And if you look across the board, let's look on a geographical level, let's look at the ARPU, which is the average revenue per user, and let's look at all categories, which is worldwide, US and Canada, Europe, Asia Pacific, and then the remaining parts of the world. And you can see that pretty much generally speaking, it's on a gradual downtrend. Some categories, such as Asia Pacific, actually went up year over year, and as well as the rest of the world. It's funny to see those actually going up, but the main issue here is mostly stemming from Europe, which went down about $2.25, and then the US, which is the big part of the revenue, went down about $3 or so. Now that's not super concerning, and so you might be looking at this and saying, Jordan, why is this down almost 20% in the after hours? And this leads me to the big problem, which is this right here. Capital expenditures. This company is eating away at its profits. Let's show you how much it's really eating at those profits. Now, just to go back here, let's go back in time. Let's go to late 2020, mid 2021, and this company was producing billions of free cash flow. So let's go ahead and look at the annual chart here, just so you can see how dramatic this is. Last year, it grew its free cash flow 65%. I'm going to repeat that just for how crazy it is. A 65% increase in free cash flow from a $23 billion number up to almost $40 billion. This company was eking out and just spitting out cash at crazy levels. And that was going fine and dandy until we got to the first quarter of 2022. We saw a little bit of a downtrend, no biggie, from $8 billion. The next quarter, it almost got cut in half to $4.6 billion. Okay, it's starting to get a little bit concerning. And then we get to this quarter. Basically zero. It put out $300 million of free cash flow, but for a company of meta size, that's basically not even worth mentioning. That's basically so incremental that it's basically zero. Look how far back you have to go to see the free cash flow number go back this low. The last time they produced a free cash flow number this low was in 2012. Think about that for a moment. It was exactly 1 decade ago, the third quarter of 2012, the last time we saw free cash flow this low. 10 years, a decade worth of free cash flow growth gone this quarter. Now, I'm not going to say it's going to stay this low. I think they will continue to eke out profits. But when you see on a 1 year basis the free cash flow down 96%, I think it's time to be a little bit concerned. And the reason is because these expenses are skyrocketing. We showed the revenue. We showed how it's flattening out and even beginning to downtrend. But what is the expenses doing? The expenses is skyrocketing. And if you look at the different categories here, you can see where it's stemming from. If we look at the sales and marketing, it's uptrending a little bit, but it's nothing that's too out of the ordinary. If you look at G&A, which is general and administrative, yeah, it's at an all-time high, but it's not really crazy. It's pretty much where we were seeing during late 2021. Nothing that's really concerning here. But the main points where you see this coming from is from two categories. The first one being R&D, which is research and development, and then the CapEx. CapEx is skyrocketing billions every single quarter. Same with R&D. Look how quickly these two, when you overlay them, how fast they're growing. It is just ridiculous. They're skyrocketing. And if you look this straight from their earnings report, you can see how dramatic this is. On a year-over-year basis, you can see year-to-date with 2022, they're at $23 billion worth of capital expenditures, and we haven't even finished out the year yet. Now, we'll see how much that pans out into future revenue, but so far, it's pretty negligible. And let's go ahead and showcase this. The bulk of these capital expenditures are being put into what they're calling reality labs, which is the fancy way of saying the metaverse. So let's look at metaverse revenues. 700 million, 500 million, 300 million, a couple hundred million every single quarter, and this quarter was 200 million. So let's just go ahead and look into this real quick. Let's analyze this. We can see that this quarter, let's go ahead and go to Qualtrim here. Let's look at quarter over quarter, let's look at CapEx. They spent $9.4 billion in the last 90 days. Think about that for a moment. That's $100 million a day. That's over $100 million a day just for this company to eke out basically no revenue. 285 million, and the loss on that was 3.6 billion. So this is the problem with this company. They're spending billions and billions of dollars to grow out the metaverse, but as of today, it's doing nothing. Now, I'm not going to sit here and tell you that the metaverse won't do something in the future. I think there's a very reasonable chance that metaverse will actually be a big thing. I think that it could potentially be a huge market for Meta and could make this the next multi-trillion-dollar opportunity. However, today as an investor, this should be concerning. $9 billion in CapEx spending, as well as you factor in the on top of that $3.6 billion loss from Reality Labs, and Metaverse just announced that they're planning on increasing the spend for Reality Labs, which is essentially the Metaverse, in the next coming year. And I think while you see these revenue charts going down and you see these expense charts going up, this is what should be concerning as an investor. And so already, if you looked at this revenue chart alone for Meta, and you see 5% year-over-year negative growth, that should already be concerning. Because if we compare this to Google, Google is an advertising company. I think it is probably one of the closest competitors, if honestly it's not the closest thing you can estimate, versus something like a Meta. Meta and Google are very similar. And if you look at their revenue quarter over quarter, you can see that the number that they just came out with yesterday was 69 billion, which represents 6% revenue growth year over year. Now, 6% revenue growth isn't amazing. It's not fantastic. But 6% growth is a heck of a lot better than 5% negative growth, which a company like Meta is doing. And Google is not reinvesting billions of dollars into something that doesn't exist yet. So the benefit to owning Meta stock, there's one major benefit to owning this company, is that it trades mighty cheap. Year over year, you can see that it's went down about 60%, and that doesn't even count today's losses, so it's more like 70 after today. But it's easy to look at this company and look at the PE ratio being at around a 10. After today's drop, who knows, tomorrow will probably end up around a 9. So a 9 or 10 PE ratio is about one of the cheapest you'll find in the markets. And I do think that this company does have lots of opportunity to produce free cash flow. And if they weren't reinvesting billions of dollars back into the metaverse, I think this would still be a pretty decent company. Honestly, if you were to do this exact same business model, if everything about this business was identical tomorrow, except the reinvestment back into the business that doesn't exist yet, which is the metaverse, I would be buying this company tomorrow. But when I see this company quarter over quarter, this quarter they did almost 20 billion in R&D and capex, and when I see how much money's being burned, it's not one that I get excited for. So don't get caught into this 10 PE ratio and say, okay, now's the time to jump in. And who knows, maybe is now the buying opportunity of a lifetime. What do I know? Do your own research and don't make a decision based on what I'm doing. But I think while it is down 5% today and down 18% in the after hours, so down over 20% just in the last 24 hours, I think it's easy to get excited about this and say, now's the time to buy. But I have to be honest, I don't know, because when profits go down 94%, the floor, the bottom of this company for where it could be going, honestly, there's no telling. So overall, it's not a business I want to own. It's not one that I'll be excited for. If things change for Meta, if they continue their growth, or I see an opportunity for them to diversify out of the metaverse, or if they start bringing in revenue from it. But in the meantime, it's not one I plan on owning, and it's not one that I plan on adding to this pie of my portfolio holdings right here. I'll keep it out for now, and I'll stick to the other tech giants, including ones that are very similar, like a Google, that I think will do much better than Meta over the next 5 years. Thank you guys so much for watching. Check out all the stuff down below in the description. My name is Jordan. I'm a millennial investor, and I'll catch you guys next time.